Hello everyone, and welcome to your end-of-week Global Macro Roundup. This week's story is not about collapse or boom. It's about divergence, late-cycle signals, and policy lines quietly being drawn across the global economy. From strong headline growth in the United States masking pressure on households, to China defending its currency without reflating its economy, to Japan's bond market flashing regime change risks, global markets are being driven less by surprises and more by what policymakers are no longer willing to tolerate. Let's start in the United States. The U.S. economy continues to project strength, but the details are increasingly uncomfortable. Inflation-adjusted GDP growth for the third quarter was revised up to 4.4%, the fastest pace in 2 years, reinforcing the narrative of U.S. exceptionalism. Consumer spending is still growing, industrial production surprised to the upside in December, and consumer sentiment has climbed to a 5-month high. On the surface, this looks like a soft landing in full swing. But beneath the headline numbers, household momentum is clearly fading. Real disposable personal income rose just 1% year over year, the weakest pace since 2022, and is now running well behind consumer spending. The U.S. saving rate has fallen to a 3-year low, suggesting households are increasingly leaning on credit and savings buffers to maintain consumption. At the same time, inflation remains stuck closer to 3% than the Federal Reserve's 2% target. This divergence matters. Growth is being sustained, but not organically. Policy uncertainty is also creeping back in. Markets are now pricing just one Fed cut by mid-year, with expectations scaled back following signals that former Fed Governor Kevin Warsh could emerge as the next Fed chair. Federal Reserve Vice Chair Jefferson reinforced that policy is close to neutral, limiting urgency for easing. On the fiscal and political front, President Trump signed an executive order restricting large institutional investors from competing with individual home buyers, while rejecting proposals to allow 401k withdrawals for home purchases. Banks, meanwhile, are exploring new credit card products capped at 10% interest rather than repricing existing portfolios, a sign of rising regulatory pressure in consumer finance. Despite growing talk of "Sell America," capital flows tell a different story. Foreign holdings of U.S. Treasuries hit a record high, with Norway, Canada, and Saudi Arabia increasing exposure, even as China continued to reduce its holdings. The world still holds a net long U.S. position of $27.6 trillion, reinforcing that de-dollarization remains more rhetoric than reality. The key takeaway is that the U.S. remains resilient but increasingly late cycle, with growth supported by balance sheet drawdowns, rising inequality, and policy credibility rather than income acceleration. Moving to China, China's message this week was subtle but deliberate: stability without reflation. China's economy expanded 5% in 2025, narrowly meeting its official target, but momentum slowed into the final quarter. The property sector remains a drag. Demographics are deteriorating rapidly, and domestic demand has yet to fully replace exports as the main growth engine. Policymakers are responding, but selectively. The People's Bank of China signaled there is still room for reserve requirement and interest rate cuts, while lowering minimum down payment ratios for commercial property mortgages from 50% to 30%. The State Council proposed structural reforms to boost consumption, including paid leave enforcement, fewer consumption restrictions, and faster clearance of overdue payments to businesses. Meanwhile, the Ministry of Finance launched a 500 billion yuan credit guarantee program aimed at supporting private enterprise borrowing. At the same time, Beijing is clearly drawing lines. China lifted its official yuan, fixing to the stronger side of 7 per dollar for the first time since 2023. This is not a bullish pivot. The yuan remains weak in level terms, but it is a clear signal of discomfort with one-way depreciation. Authorities want stability, not speculation. This balancing act extends to industry policy. regulators announced a unified national subsidy framework to curb destructive price wars in the auto sector, while Canada's new auto strategy may allow Chinese EV makers to assemble vehicles domestically, deepening global supply chain entanglements. Overlaying all of this is a powerful structural force: China's population decline, now the steepest since the 1960 Great Famine. That demographic shift reinforces why policymakers are focused on productivity, technology, and financial stability rather than demand-driven stimulus. China is not trying to surprise markets. It is trying to control expectations. In Europe, excluding the United Kingdom, Europe's macro picture is quietly improving, but remains fragile and politically sensitive. Euro area private sector activity maintained moderate growth in January, with Germany's early recovery offsetting continued weakness in France. ECB minutes showed policymakers believe current policy settings are appropriate while retaining flexibility, a signal that rate cuts are unlikely to be rushed. Trade policy, however, is where Europe made headlines. The EU suspended retaliatory tariffs on $93 billion of U.S. goods for another 6 months following Trump's decision to back down from tariff threats linked to Greenland. At the same time, Germany pushed to provisionally implement the long-awaited EU-Mercosur trade deal, while Europe and India moved closer to a landmark agreement covering nearly a quarter of global GDP. These moves signal a clear European priority: trade diversification amid geopolitical uncertainty. Institutional investors are also recalibrating. Europe's largest pension funds reduced U.S. Treasury exposure over concerns around fiscal discipline, a weaker dollar, and rising geopolitical tension, a small shift in flow terms, but symbolically important. Meanwhile, European banks are increasingly turning to significant risk transfer markets to hedge over $200 billion in stressed commercial property exposure, highlighting where financial stress remains concentrated. Europe isn't accelerating, but it is adapting. Let's talk Canada. Canada's outlook continues to darken at the margins. Inflation accelerated to 2.4% in December, above expectations, driven partly by base effects from last year's tax holiday. While core measures cooled, business and consumer confidence remain subdued. Bank of Canada surveys show firms are hesitant to hire, consumers are worried about job security, and food prices remain elevated. Retail sales are expected to grow just 0.2% in Q4, and household consumption is forecast to slow to 1.5% in 2026. Housing remains a major drag. Toronto condo sales fell 60% last year, the weakest since the early 1990s crash, with dozens of projects canceled, a clear signal of development slowdown. On trade, the Carney government is pushing to double non-U.S. trade over a decade, with India emerging as a key partner. At the same time, domestic political tensions are rising over EV agreements with China, as provincial leaders warn about job losses. Canada is navigating a world where reliance on the U.S. is no longer a safe assumption. But diversification will not be painless. In the UK, fiscal optics improved even as markets grew uneasy. Government borrowing fell more than expected in December, helping Chancellor Rachel Reeves reinforce fiscal credibility. She signaled no additional tax hikes are planned this spring, arguing that increased fiscal headroom has restored confidence. But markets were less reassured. UK gilts suffered their worst week since November, as investors reassessed duration risk and inflation persistence. Headline inflation came in hotter at 3.4%, though largely due to one-off factors. Unemployment continues to edge higher, now at 5.1%, reinforcing a slow-growth, sticky inflation backdrop. The government also rolled out reforms to revive the UK IPO market, easing listing rules for private equity, an acknowledgement that London's capital markets have structurally lost appeal. Temporarily, the UK is stabilizing fiscally, but growth credibility remains fragile. Moving on to Japan, Japan delivered the most volatile market signal of the week. Prime Minister Sanae Takaichi called a snap election in an effort to secure a stronger mandate for fiscal stimulus, triggering immediate concerns about debt sustainability. Japan's bond market reacted violently, with long-term yields spiking in what traders described as one of the most chaotic sessions in years. The Bank of Japan held rates steady at 0.75%, with Governor Ueda striking a cautious tone. But markets are no longer waiting for guidance. The bond sell-off reflects growing belief that Japan's ultra-easy era is ending, even if normalization remains gradual. The yen added drama, staging its biggest one-day rally since August on speculation of potential intervention, underscoring how sensitive markets have become to policy credibility. Japan is now a live case study in how fiscal politics can overwhelm central bank caution. So what ties all of this together? Across regions, policymakers are signaled the following limits this week. The US is nearing the limits of consumption-led growth. China is drawing lines on currency stability. Europe is hedging geopolitical risk through trade. Canada is confronting structural demand weakness. The UK is prioritizing fiscal optics over growth. Japan is facing the cost of political risk in bond markets. This is not a week of collapse, but it is a week where late-cycle dynamics became harder to ignore. Thanks for watching. If you found this helpful, like, subscribe, and I'll see you next week.